Let's talk about CarMax, though, here this morning. Shares of CarMax, halting or hitting the brakes. They are down following its latest quarterly results. The used car retailer reporting a massive miss on earnings as car sales slide and expenses rise here. And
a terrible quarter, Scott, any way you look at it, because all of the key metrics, they missed. And if you take a look at earnings per share, revenue, unit sales, all of them were below expectations.
CarMax just lost $300 million. And that number is only the beginning. The largest used car dealer in America, a company that moves thousands of cars every single week, is now parking vehicles in the driving aisles because they have run out of room to store the ones nobody is buying. They fired their CEO, they cut hundreds of jobs, they slashed prices across the board, and buyers still said no. Think about that for a second. The biggest used car operation in the entire country dropped its prices, and people looked at those lower numbers and still walked away. That does not happen unless something much bigger is breaking underneath the surface. Because here is the part nobody is saying out loud. There is one company right now that looks like it is winning while CarMax drowns. Same market, same broke customers, completely opposite results. And the reason why should terrify anyone who is thinking about buying a used car in 2026. So the question you need to answer before you step foot on any lot is this: is the used car crash that just swallowed $300 million about to make your next car deal the best of your life, or the worst financial mistake you ever made? CarMax is the largest used car dealer in the United States. Not one of the largest. The largest. A company that built its entire identity around moving thousands of vehicles every single week, in every corner of the country, like clockwork. And right now, if you walk onto one of their lots, you will see something that should not be possible for a company this size. Cars parked in the driving aisles. Vehicles sitting in overflow areas that were never designed to hold inventory. Units lined up so tight that the lot itself barely functions anymore. This is not a small regional dealer having a rough quarter. This is the biggest used car operation in America, running out of physical space to store the cars it cannot sell. So how does this happen? It starts with timing. When the market was hot, CarMax did exactly what every dealer does. They bought aggressively. They stocked up. They paid high prices to acquire inventory because buyers were everywhere and the money was flowing. That was the playbook. And for a while, it worked perfectly. Then the buyers disappeared. Not slowly, not gradually, in a way that gave anyone time to adjust. The demand just stopped showing up the way it used to. And CarMax was left holding thousands of vehicles purchased at peak prices in a market that had already moved in the opposite direction. Here is where the math turns brutal. Every single day a car sits on that lot, it loses value. Depreciation does not pause because sales are slow. It does not care that CarMax paid top dollar to acquire the vehicle. The clock starts running the moment that car arrives on the asphalt, and the longer it sits, the wider the gap grows between what they paid and what they can realistically sell it for today. And the inventory keeps coming. Because at a company this size, the buying pipeline does not just switch off overnight. Contracts are already in place. Auctions are already scheduled. Vehicles keep arriving on a timeline built around a demand level that no longer exists. So the lot fills further. The aisles get tighter. The overflow areas hit capacity. And somewhere in a corporate office, the numbers on a spreadsheet get harder and harder to explain to shareholders. This is what an inventory crisis actually looks like from the inside. Not a quarterly earnings footnote. Not a headline you scroll past. Real cars sitting on real asphalt, bleeding value every single day, while the company scrambles for a solution. But here's the thing. Too much inventory is just the symptom. The disease is something deeper, something far more expensive to fix. Because CarMax did not end up here by accident. The consumer who was supposed to show up and buy all of these cars simply stopped coming. And that is where this story gets a lot more complicated. Sales are down 10% year over year. That is the headline number. That is the figure showing up in earnings calls and investor reports and financial news tickers. And on its own, that number sounds bad, but manageable. A rough patch, a market correction, something a smart company with deep pockets can wait out. But here's the part that should stop you cold. They already cut the prices. This is not a situation where CarMax stubbornly held the line on inflated numbers while buyers walked away. They saw the problem, they responded, they dropped prices across the board and waited for the buyers to come back. And the buyers looked at those lower numbers and still said no. That tells you something critical about what is actually happening here. Walk through the math with a real example. Take a 2022 Jeep sitting on the lot at $30,000. No buyers. Drop it to $27,000. Still no buyers. Push it down to $25,000. And maybe you find someone willing to sign. So you sell it. Problem solved. Right? Wrong. Because now CarMax has to go replace that Jeep. And when they go back to the auction to restock, they are not buying in a vacuum. Carvana is at that same auction. Other dealers are at that same auction. And those competitors are still willing to pay $26,000 or $27,000 for the exact same vehicle. So CarMax sells at $25,000 and restocks at $26,000. Do that math across thousands of vehicles, and you are not running a used car business anymore. You are running a very expensive charity. This is the trap squeezing CarMax from both directions at once. Lower the prices to move the metal sitting on the lot, but pay full market rate to refill it because the competition is not dropping what they will pay to acquire cars. There is no version of that equation where the numbers work cleanly. And the deeper truth underneath all of this is the one nobody at CarMax wants to say out loud. If dropping prices is not bringing buyers back, it means the price was never actually the barrier. The buyers are not sitting at home waiting for a better deal. They are sitting at home because they cannot qualify for the loan, cannot afford the insurance, cannot absorb another monthly payment on top of everything else already pressing down on their budget. The consumer was already broken before CarMax dropped a single dollar off a single sticker. And once you understand that, the 10% sales decline stops looking like a speed bump. It starts looking exactly like what it is. The beginning of something much bigger and much harder to reverse. When a company the size of CarMax fires its CEO, that is not a routine leadership change. That is not a quiet reshuffling of the org chart while everything else stays on course. That is the board sitting in a room, staring at the numbers, and deciding that the person steering the ship does not have what it takes to navigate what is coming. It is an admission that something is fundamentally broken and that fixing it requires a completely different kind of thinking at the very top. So, who did they bring in to lead the largest used car dealer in America through the worst market conditions it has faced in years? The former CEO of Holiday Inn Express. Let that land for a second. Not an automotive veteran, not someone who spent decades understanding inventory cycles, vehicle depreciation, subprime lending, or the mechanics of moving thousands of cars off lots at scale. A hotel executive. Someone whose entire professional background was built around hotel rooms, loyalty programs, and guest experience scores. The stock market made its opinion clear the moment that announcement dropped. Shares sold off 10% in a single session. Investors did not need time to think about it. The reaction was immediate and brutal, because what the market heard was not a bold visionary move. What the market heard was a company that has run out of conventional answers. And here's the thing, the board at CarMax is not stupid. These are not people making random decisions under pressure. The choice to bring in someone from completely outside the automotive world is deliberate. It is a calculated bet that CarMax's survival does not depend on selling cars better. It depends on becoming a technology company that happens to sell cars. Digital transactions, streamlined financing, a buying experience that looks less like a dealership and more like an e-commerce platform. That is the vision. That is what the Holiday Inn executive is being brought in to build. Someone who understands customer experience at scale, digital transformation, and brand repositioning in a market that has turned against them. The problem is that vision does not solve what is happening on the lot right now. You cannot digitize your way out of a 10% sales decline when the consumer is already tapped out. You cannot build an app that makes someone qualify for a loan they cannot afford. The cars are still sitting in the aisles today. The inventory is still bleeding value today. The layoffs are still coming today. Bringing in a hotel executive to fix a car crisis might be exactly the right long-term move. Or it might be the most expensive experiment in automotive retail history. Right now, nobody knows which one it is. And that uncertainty is exactly what is making investors so nervous. Here is the question that is eating CarMax's board alive right now. How is Carvana winning while we are drowning? Same market, same stretched consumer, same rising delinquencies, same impossible financing environment squeezing buyers from every direction. And yet, while CarMax stock has been cut in half, Carvana's numbers have been trending in the opposite direction. To any investor sitting across both of those charts, that gap looks insane. And it is driving exactly the kind of boardroom panic that gets CEOs fired and hotel executives hired. But here is what that comparison is actually hiding. Carvana is not primarily a car company, never really was. The cars are the front door. The product being sold out the back is something else entirely. Carvana's real business is loans, writing them, packaging them, and selling them off for profit before anyone has to find out whether the borrower can actually pay. Here is how the machine works. Carvana writes loans for buyers who, in a functioning lending environment, would never get approved. They package those loans together and sell them to outside companies at elevated prices that no rational third-party investor would actually pay. And here is where it gets uncomfortable. The companies buying those loans at inflated prices are owned by the Garcia family, the same family that controls Carvana. So Carvana sells overpriced loans to companies that are essentially themselves, books the profit, reports strong earnings, and the stock price goes up. Then the Garcia family sells stock at that elevated price, takes that money, buys more loans, stock goes up again, sells more stock. The circle keeps spinning as long as nobody looks too closely at what is actually inside those loan packages, or questions why any rational company would pay a premium for assets quietly rotting underneath the surface. A prominent short-selling firm looked closely. Their report accused Carvana of misleading shareholders, inflating earnings through related party transactions, and building what appears to be a financial house of cards held together by the same family's money, cycling through different corporate shells. The uncomfortable reality is that Carvana's performance and CarMax's performance might not be opposites at all. They might be the same story told two different ways. One company avoided the worst subprime exposure and is now visibly suffering for it. The other papered over the damage with engineering and is still waiting for the moment the music stops. Because the music always stops. And when it does, a lot full of unsold cars at CarMax is going to look like the least of this industry's problems compared to what unravels on the other side of those loan packages that nobody wanted to examine too carefully. Before we go further, if you want the complete breakdown of every vehicle draining buyers the fastest in 2026, I put together a free ebook called Avoid These 17 Cars in 2026. Depreciation data, reliability scores, the exact models showing up on repo lots right now. Link is in the description. Download it before you walk onto any lot. $150 million. That is the number CarMax put on the table when they announced their cost-cutting plan. And if you hear that figure and think it sounds like a corporate accounting exercise, a line item shuffle that happens somewhere far away from real people, you are thinking about it wrong. $150 million in cuts means bodies. It means people who showed up to work every single day, clocked in, moved cars, processed paperwork, ran financing desks, managed lots, answered phones, and kept this entire machine running, are now looking at termination notices and wondering what comes next. Layoffs, restructuring, store closures. That is what $150 million translates to when you strip away the corporate language and look at what it actually means on the ground. And this is not happening in isolation. The auto industry around CarMax is fracturing at exactly the same time. Stellantis, the parent company behind Jeep, Dodge, and Ram, has been taking body blow after body blow, plants shutting down, production lines going quiet, workers sent home with no clear timeline for when or whether things come back. The manufacturers are bleeding, the dealers are bleeding, and now the used car giants are bleeding too. Every single layer of the automotive food chain is under pressure simultaneously. And the people absorbing the most pain are always the ones at the bottom of the org chart, never the ones who designed the strategy that created the problem in the first place. Here is what makes this particularly damaging beyond the individual job losses. CarMax stores are not tucked away in industrial parks where their closure goes unnoticed. They sit in retail corridors surrounded by restaurants, service businesses, and shops that depend on the foot traffic and economic activity a major employer generates. When a CarMax closes, the ripple moves outward through the surrounding businesses, the local tax base, the neighborhood employment numbers. One store closure is not a corporate restructuring line item. It is a neighborhood economic event that nobody voted for and nobody saw coming. Then the feedback loop tightens further. Laid-off CarMax employees become consumers with less money. Consumers with less money buy fewer cars. Fewer car sales means less need for staff at the dealerships still operating, which means more cuts, which means more consumers with less money. The cycle feeds itself, and each rotation pulls more people into the current. This is the part of the story that never makes it into the earnings call. The human infrastructure behind these numbers is crumbling quietly, while the headlines stay focused on stock prices and CEO appointments. $150 million in cuts sounds like a business decision. For the people holding those termination notices right now, it feels like the ground disappearing underneath them without warning. Everything we have covered so far, the overflowing lots, the falling prices, the fired CEO, the layoffs, all of it traces back to one single root cause. The American consumer is broken, not bending, not stretching, not temporarily stressed in a way that an interest rate cut or a good tax season will quietly fix. Broken. And this is not a feeling or an opinion. This is showing up in the data from every direction at once. Credit availability is tightening as lenders pull back on approvals. The borrowers they were saying yes to 18 months ago are now the ones missing payments and losing cars to repo trucks before sunrise. Delinquency rates are climbing. The loans that looked manageable when they were written are revealing themselves for what they actually were. Bets placed on income stability and financial breathing room that millions of Americans simply do not have anymore. And here is what makes this particularly hard to fix. The consumer is not saying no to cars because of price alone. They are saying no because they are exhausted. Maxed out credit cards, rent that has not come back down, grocery bills that never stopped climbing, insurance costs that jumped and stayed jumped. When every single monthly obligation is already pressing against the ceiling, there is no room left for a car payment. It does not matter how many times CarMax drops the sticker price. You cannot discount your way into a wallet that is already empty. This is the buyer that fueled the 2021 and 2022 car market. The subprime consumer who got approved fast, signed long loan terms, drove off the lot feeling like they had won something. Those same buyers are now the ones showing up in the delinquency numbers, the ones whose cars are getting pulled before sunrise. The party that the whole industry threw during those peak years is now presenting its bill, and the consumer is the one being handed the check. CarMax, to their credit, pulled back from the worst of the subprime exposure. They made a deliberate decision not to chase the bottom of the credit pool the way some competitors did. That discipline is the reason they are still standing while others are quietly unwinding. But that same discipline is now a ceiling on their recovery. The buyers they are willing to approve are fewer in number. The buyers who could qualify are fewer in income. The overlap between those two groups is shrinking by the month. The one flicker of light is tax season. Refund checks create a brief pulse in spring traffic and sales. It is real. It moves numbers. But it is a season, not a solution. And when it ends, the same broken consumer is still standing there on the other side of it. The trajectory here is not a mystery. The numbers are moving in one direction, and that direction is not better. The reset is coming. That is not a prediction. That is not a doom headline designed to scare you into clicking. It is the only logical conclusion when you follow the numbers to where they are actually pointing. The question is not whether the used car market corrects. The question is how deep that correction goes and how long it lasts before anything resembling normal shows up again. And CarMax's biggest challenge through all of this has nothing to do with their new CEO or their digital strategy or their brand. It is scale. A small independent lot can move fast. If a car sits for 2 weeks, drop it $500. Sit another 2 weeks, drop it again. Find the number, sell the car, move on. That kind of surgical price discovery is impossible at CarMax's size. Every percentage point they shave off pricing across thousands of vehicles is not a rounding error. It is millions of dollars evaporating from the balance sheet in a single decision. So they move slowly and carefully while the inventory keeps bleeding value underneath them every single day. For anyone who bought a used car between 2021 and 2023 at peak market prices, what is coming next is not good news. Those vehicles were purchased at numbers the market has already walked away from. As dealer prices continue dropping to find real buyers, the gap between what those owners owe on their loans and what their car is actually worth in today's market is going to widen. Negative equity, underwater, trapped in a vehicle you cannot afford to sell without bringing cash to the table just to break even. But here is the other side of that same story. For the patient buyer, for the person who waited, for the one who did not panic purchase at the peak, this market is slowly becoming the most favorable buying environment in years. Cash buyers especially are walking into negotiations with leverage they have not had since before the pandemic flipped the entire used car market upside down. The lot is full, the prices are falling, and the dealership needs to move metal far more urgently than you need to buy today. The warning for anyone considering financing right now is simple. The market is correcting, but it has not finished correcting. Prices are falling, but they are not done falling. The buyer who moves too early locks in a number the market will beat in 3 months. Patience right now is not hesitation. It is strategy. Come back to that opening image one more time. A CarMax lot so full that vehicles are parked in the driving aisles. That image is not a temporary inconvenience. A new CEO and a price cut will quietly resolve. It is a symptom of something much larger, breaking down across the entire used car market all at once. Prices got too high, loans got too loose, consumers got too stretched, and the industry that built its recent profits on all three of those conditions is now watching all three unwind simultaneously. CarMax is the most visible casualty right now because of its size, but the same pressure sitting on their lots is sitting on every major used car operation in this country. The name on the sign changes. The problem underneath is identical, and it is not going away quietly. This is not a temporary blip. This is not a headline that looks different next quarter. The numbers are moving in one direction, and that direction is not better. Inventory stays elevated. Demand stays weak. The financial pressure squeezing every household in America is not suddenly going to lift because CarMax needs it to. The reset that is coming for this market is not a question of if, it is a question of how deep and how long. But here is what that means for you specifically. The people who understand what is actually happening right now are the ones who come out of this ahead. The patient buyer who recognizes that prices have further to fall. The consumer who refuses to be rushed into a financing decision by a salesperson working against a quota. The person who walks onto a lot carrying data instead of emotion. Those are the people this market is about to reward. And that advantage only exists for the ones paying attention right now before the rest of the crowd figures it out. The lot is full. The prices are falling. The only question left is whether you are the one taking advantage of this moment or the one still waiting while someone else does. Before you step foot on any lot, download the free ebook, Avoid These 17 Cars in 2026. Depreciation charts showing exactly which vehicles hold value and which ones crater the moment you drive off the lot. Reliability data pulled from real owners. The specific models that mechanics see on their lifts week after week. The cars that insurance companies already know will cost you before you even find out yourself. Link is in the description. Download it, read it, then go negotiate. The lot is full. The prices are falling. Make sure you are on the right side of this.